Hi everyone, I'm Terry Ryder, founder of Hotspotting. Welcome to this special webinar in which Hotspotting General Manager Tim Graham is joining me to give you the best insights into one of our most revealing research reports, the one we call the Pulse. And why is this report so important? Because it shows you that you can achieve property investments that tick all the boxes in ways that many people would think were not possible. Affordable locations, high rental yields, and great capital growth. That's right, you can have the best of both worlds. You don't need to choose between price growth and high rental returns, and that's our topic tonight. But I think it's fair to say, Tim Graham, that many property investors do believe that you do have to make a choice between growth and yield when you're selecting a location for property investment.
Yeah, it's always been the saying that you can choose one or the other. You can't have your cake and eat it too. But with the results that we're going to go through tonight, that sort of look back over the last 12 months, and even more recently, you look at the last quarter, some of the results that you get, and they're pretty remarkable. So I do think you can have your cake and eat it too.
Yeah, some of the results are quite spectacular, and I suppose some people might have an expectation. Sure, if you talk about Perth and Western Australia, you're getting these amazing results, but there's plenty of other parts of Australia that have also been having this wonderful combination of high rental yields, big rental growth, and also great capital growth in the
Yeah,
last 12 months.
absolutely. Well, we've got a great turnout tonight, Terry. Lots of familiar names in there, but lots of new ones as well. So it's obviously a topic that people are interested in. They're all chasing a good yield in a high interest rate environment.
Okay. Well, we've got a fantastic presentation to give to our listeners and observers tonight. I'm going to share my screen and take you through a slideshow. You and I are going to discuss the key points that we're throwing up there in terms of the background data. Some of it quite remarkable stuff. We're going to talk about some of the locations that illustrate the points that we're making tonight as well.
Absolutely, and then a special offer at the end of it, which you could call a Black Friday deal, but it's going to flow all the way through to the end of the year. So stick around for that. While Terry's getting that ready, just a bit of housekeeping. We're planning on having a chat for about 45 minutes this evening. We'll allow about 15 minutes for Q&A at the end. So keep your questions coming. You've got a Q&A box on Zoom that you can put your questions into. If anything does pop up throughout the presentation as a question that we think is relevant, we'll try to jump into it straight away. Otherwise, we'll endeavour to get to as many questions as we can at the end. Over to you, Terry.
Okay, thanks, Tim. Just confirm for me, you can see those slides as I'm hoping they would. So we're talking about achieving more than a 6% yield without compromising growth. In fact, a lot better than not compromising growth, achieving fantastic capital growth if you choose your locations really well.
Yeah.
So our agenda simply tonight, we're going to talk about the best locations that have been revealed by the report we call the Pulse, which we'll describe to you in a moment. We're going to talk a little bit about our empirical formula, which is a set of parameters that we use to choose locations that we're comfortable to recommend to our customers. We're going to have time for your questions, and there is also a special offer at the end of the presentation tonight. So I just wanted to start by showing everybody the sort of growth that is commonly achieved in Australian real estate over time. And we all know that one of the mantras of real estate is that you need to take a long-term view, and the longer you hold real estate, generally speaking, the better the outcomes. There's some interesting recent data from one of the major research entities, I think it was CoreLogic, which showed that the average hold time for real estate in Australia is something like 8.5 years. So people don't actually hold real estate perhaps as long as maybe they should to get the best outcome. But those who do can get these pretty spectacular results. So we've gone back to using ABS data to 1980, and it's probably a lot of people watching will find it almost impossible to believe that you could buy the typical house in Sydney for less than 70,000 in my lifetime, and less than 40,000 in Melbourne and Brisbane. But and now, of course, we're well over $1 million in Sydney for the typical house on a block of land.
If
And
If you did buy a property in Sydney at 68,000 in 1980, the only question to follow that up with is why didn't you buy two or three or
or 10, or
yeah,
10.
exactly.
But of course, back then, 70,000 was actually quite a lot of money.
Yeah, of course.
At about the time when I was really starting out in working life, working in newspapers, and relative to the amount of money I was earning a week, that was a lot of money. So it's all relative to incomes. Having said that, the multiples in terms of what property values are worth versus typical incomes has grown, but
Mm.
nevertheless, it was a bit of a hump for people to get over back then, to get together the deposit. In many ways, it was actually harder to get a loan and buy a piece of real estate back then. There weren't as many lending options.
Yeah.
There wasn't any government assistance. There weren't any stamp duty concessions, etc. But of course, the one way in which it was easier way back then was that relative to incomes, property was a little bit cheaper.
So
But
Terry,
I suppose,
before we jump into the pulse, there's that PIPA survey or the PIPA research paper that came out, which I know you did a podcast on this week, which I thought was I listened to that myself on the way home from picking up my daughter from childcare today, and the results of that were quite remarkable. Did you want to share that with the audience tonight? It was
yeah,
I found it really enlightening.
well, that's right. We're talking about the 20-year growth,
Yeah.
at PIPA, and I think the results of that would surprise a lot of people because what they did is they divided Australia into the 14 or 15 major jurisdictions. There's 8 capital cities and there's 7 state and territory regional markets. And of the 15, they asked the question, which one has had the best capital growth over the past 20 years? Um, the answer was actually regional Tasmania, which probably would not be the first pick of most people.
No.
Most people would have thought, well, maybe Sydney, the most expensive city, or Perth, which has been having spectacular growth and leading the nation for the last couple of years, or Brisbane, which Brisbane in Queensland seems to have perennial growth. But no, it was regional Tasmania. And number 2, I think, was Adelaide, and then came Brisbane and Hobart. And Melbourne and Sydney were well down the list in terms of that long-term growth pattern. But the other
Isn't
remark,
it interesting when you think of the word affordable? I mean, we probably still see rest of Tasmania outside of Hobart as quite affordable, but certainly living there, having seen people that are living there, having seen that much growth, would certainly not think it's affordable anymore.
well, no, and affordable is relative, and I
Mm.
think there's a lot of media out and about today about the latest report on affordability, and the problem does get worse. And I probably need to avoid getting sidetracked and getting on my hobby horse about the whole issue of affordability. How we in Australia we talk about it, we've been talking about it for decades, but we never fix it,
Yeah.
and that's down to our politicians. But that's not really our topic tonight. One of the things that's a feature of the sorts of locations we're presenting tonight from the report we call the Pulse is that they are affordable. Um, the 3 main characteristics of this report is that the locations are affordable, they have fantastic rental yields, but they also are achieving really good capital growth. But the question we're posing with the slide that's on screen at the moment is that's the sort of growth that's been achieved over time. Can you achieve that kind of growth in locations that give you great rental yields and that are affordable to buy? And I think the proposition we're putting tonight is that yes, you can if you get your locational choice right.
Yeah.
So if you can achieve that, you're achieving what we think is real estate's ultimate win-win-win situation. The first win is that you're buying at an affordable price. The second one is that you're getting a really high rental yield, well above average. And the third is you're also getting great capital growth if you're getting your locational choice right. And we help people do that with the hotspotting business by using our empirical formula. And it's probably worth taking a little bit of time to explain what that means. Empirical is a anagram. Is that the right word? Acronym. Sorry,
Acronym.
which means that each letter of the word empirical stands for something that is meaningful for our formula. And we apply this formula to all locations that we're comfortable to recommend. The E in empirical stands for economy, and we're very, very fussy about recommending locations that have economies that are strong and diverse. Diversity is really important. We're not going to ever recommend a mining town because that's the only thing in play there. And if the resources sector goes through a period of downturn, as happens cyclically, then the property market of a town that's totally and solely dependent on that sector is going to suffer. And we've seen spectacular examples of that over time. It's probably the only example in Australia, in my experience, where property values have fallen dramatically is in those mining towns like Port Hedland in Western Australia and Moranbah in Queensland, those kind of places.
You've also, talked about agricultural areas and tourism areas, anything that's a bit of a one-horse town.
Absolutely right. There may be some wonderful regional towns and centres out there, but their economies are pretty much wholly and solely dependent on the agricultural economy. And if there's a drought, for example, or some other downturn in that sector, the property market's inevitably going to suffer. So we're looking for economic diversity. The M in Empirical is market size. We're unlikely to ever recommend a small town. We want a market that's got a certain amount of critical mass, a minimum of 50 households in the past 12 months. Population is important. We're not going to recommend locations with a population of 3,000 or 5,000 people, unless sometimes we do make exceptions to our rules, but it has to be for very, very special circumstances. We very seldom recommend a location that's got less than 15,000 people, and we're most comfortable if the centre we're recommending has at least 50,000 people. And it's nice if that population is growing as well. There are parts of Australia where population growth isn't important. Our established suburbs in our major cities, for example, they can be completely built out. There's no population growth happening there, but nevertheless, they can have very strong property markets with growing values. Infrastructure, that we're very, very strong on this one. We like locations that have good existing amenities, but in particular, we feel that investment in major new infrastructure projects is an enormous generator of growth in real estate because it generates economic activity that creates jobs, and the jobs that are created lead to demand for real estate. So some of the best performing markets that we've charted over the last, say, 4 or 5 years have been massively pumped up by big infrastructure. The Sunshine Coast is a great example of that. There's plenty of Toowoomba, a more recent one. The rental market, obviously, we're looking for places with low vacancies because that's when we're most likely to see rental growth, and those are high rental yields that we're looking for in this particular report.
That's probably the one in across Australia that's the easiest to find at the moment, Terry.
Well, it is, but there are plenty of places that have vacancies that are 3, 4, 4% and higher. But the majority, you're right, have vacancies that are at historically low levels. But nevertheless, it's something to keep an eye on. And it's not just low vacancies. We want to make sure that rentals are growing. There are some parts of Australia already that have got to the point where they've reached perhaps a rental ceiling. Even though vacancies are really low, the market can't sustain rents just rising and rising because people who rent, not all people who rent are at the lower income.
Well, that's it, but that's also changing, a bit of a demographic change where we're starting to see, household combinations changing because people just can't afford to pay anymore. So they're starting to live with family members, and the household is actually starting to get larger, whereas throughout COVID it got smaller.
Well, that's right, and we're also seeing tenants trying to get over the affordability factor with rents going up and up by squeezing more and more people into a dwelling. So, some of our property management contacts, they're on our panel of partners, for example, like Image Property, have told us how it used to be the norm that if there was a house for rent, they might have 1 or 2 names on the lease, but now it's common for 5 or 6 names to be on the lease because that's how many people are proposing to live in like a 3 or 4 bedroom house. Because it's the only way they can afford the rental level. So there is a ceiling. We're starting perhaps see a slowdown, generally speaking, in the rental growth around Australia because that ceiling is being reached and the market just can't keep on paying 10-20% increases in rents year after year. The I stands for increasing employment opportunities, evidence that jobs are being created, and it's all about the local economy being dynamic and creating jobs. So that's important as well, because obviously that feeds into real estate demand,
Yeah.
capital growth. So strong potential for growth within 5 years and longer. And we do like we're reluctant to recommend places that have been having strong capital growth for, let's say, the past 2 or 3 years, like Perth, for example. A lot of people are pulling that market at the peak of a boom.
Yeah.
Where we're more likely to recommend locations that are early in the cycle, but we do like to see some evidence that beginning of the capital growth cycle is starting to happen. What we call the second wind markets. Affordability is important to so many people. Not all investors are looking to buy in the 400, 500,000s, but many of them are. Many of them have to, because they don't have the borrowing capacity to pay more. And it's also the reality of real estate that you get the higher rental yields, the lower the price you're paying, the higher the rental yield tends to be. It's very
It's
unusual.
worth sort of expanding on that a little bit as well, Terry, about why people tend to do that. Obviously, rental yields are important, but certainly in a high interest rate environment now, we can't be, especially if you're paying a mortgage at home, you can't be expected to be, pulling money out of your pocket to service another property. And it's really important now more than ever that when we are in a high interest rate environment, that the yield's very important. So we start to get higher up, the yield starts to drop away. It's going to cost you more out of pocket.
Yeah, absolutely right. So the affordability factor is important from a number of respects, particularly for those people who do need the higher rental yields to at least try and get to a break-even situation.
Yeah.
And the L stands for, lastly, in the empirical formula for low risk. It's really important, we think, not to see people jumping into volatile markets that present high risk for consumers. I mean, there are certain types of investors, perhaps investors that have experience, that have a substantial portfolio, can afford to take on a property in a location that's a little bit higher risk. Like
especially if you're not taking on any debt. If you've got no debt on the property, you can probably afford to have it vacant for a little bit. So you can target some places that are going to give you some higher cash flow when it is tenanted.
Yeah, and a case in point is Darwin. We're starting to get more and more inquiry from our customers about what do we think about Darwin? Should they be buying there? Because the reality is that Darwin's very affordable relative to other capital cities. Is by far the highest rental yields of the capital cities. The question is, are they going to get capital growth? Because Darwin market has not performed on capital growth for a couple of years, and it can be quite a volatile market. So that's the question that we ask. And I'm actually not totally sure right now what the correct answer is for people. I can see the attraction of Darwin from a couple of respects, but just whether it's going to have the strength of economy, the creation of jobs to generate capital growth. Yeah.
So, Terry, a couple of questions. The first one's from me, and then the next one's from Josh. Good to see you, Josh. I'll ask you a question in a moment, but before we get to that, the word hotspot. It actually, for a lot of people, probably they think that it means a flash in the pan hit of growth. Like you get into a market, and then all of a sudden you get this big spurt of growth, and then likely it might stop. But what the empirical formula is about is identifying locations that are more of a long-term view, don't we?
Well, that's right. And sometimes people do get, as you say, a misleading impression on the words hotspot. And there's some part of me wishes, if I had my time over again, maybe I would have chosen a different brand name for the business. But way back when I started this business almost 20 years ago, I did choose hotspotting because it means something different to me. It means a location that's going to outperform the general market over time. But it
Well,
does.
we're about to see some of those results, so we'll be able to prove it. But before we do that, Josh has got a question that says, does this empirical formula apply to military towns like Townsville? So Townsville's an interesting one. I'll throw it across to Telly to give his point of view in a moment. But one of the things we talk about now more than ever in terms of risk is things like climate. Right. So a little tip for people out there is one of the first things I do when looking at real estate, in buyer's advocacy world or trying to buy a property for myself, I will grab the address and I'll go straight to a website like St. George Insurance and I'll put that address directly in there and get an instant quote. And that, to me, will tell me whether or not it's a high risk investment, because I can assure you insurance companies are doing a hell of a lot of due diligence. Townsville's a great example of that. It's and Terry, you can talk to why it's such an exciting market in a moment. But for me, one of the things that's stopped me going into that market, and I've never actually bought in there myself or helped anybody buy into there, is because it looks great on paper. But the problem is the net yield is not great. The insurance levies are huge. And and I must say that obviously is a market that's had some strong growth over the last couple of years. So if there was a time to buy there and you could weather some of those higher expenses, it's probably starting to surpass, in my opinion. But yeah, in terms of an exciting market, it ticks a lot of boxes.
It does, and I don't agree that Townsville is a military economy. Yes, Townsville has a very
Right.
strong military presence. It's got a big RAF base, it's got a big army base, but it's got so much more. I
Yeah.
love Townsville from the viewpoint of economic diversity. It's probably one of the strongest regional cities in terms of the economy in all of Australia. The only black mark against it is the one you've raised. It's the size of the insurance premiums that are charged because it's up in the tropical north, and so it's
I mean,
considered to be
you
susceptible.
you go back to 2 or 3 years ago when interest rates are in the 2 and 3%, and it's absolutely in play. But if cash flow is important to you now, and even cast an eye forward a couple of years. I was at a conference recently where somebody on stage who's from a large publication here in Australia in terms of real estate said there's a very good chance that 10% of Australia won't be insurable within 2 years due to climate. So you start to hear some of that rhetoric, and that can make you really think about the fact that you're not buying real estate like you are shares where you can easily sell it tomorrow. It's something that we're likely to be holding long term, and those are the types of considerations we need to be thinking about now more than ever.
Yeah, so you sort of wonder, you might choose a location and go through the empirical formula and see how many of those parameters it ticks. When you're talking about Townsville, it might not tick the low risk box
Yeah,
because of that climate factor and the impact it has on insurance premiums. Ticks every other box for me, and
yeah,
it's producing wonderful capital growth at the moment. The rental yields, the gross yields are really high, but
yeah.
you're right, Tim. By the time you factor
And
in
it's like anywhere, there's certain areas that are more prone to risk than others. I don't want to black mark Townsville and say that there's nowhere that you should buy. There's plenty of places you could buy that probably aren't in flood zones and probably aren't in areas of going to get hit by cyclones and things like that. So it all comes down to the property itself and where you buy.
Sure. So moving on, that's our empirical formula. Now, turning our attention to this report we call the Pulse, and Tim, it probably be a good idea to actually explain to people what that report is and why we started. It's quite a recent report in our portfolio of our stable of reports.
Yeah, we probably started that report. It'd have to be close on 18 months ago now, Terry. And I remember at the time when we started producing it, we said this is a report for the times in terms of the fact that we started to see this escalation of interest rates. It felt like every time the RBA meet, another one, another one, another one. So all of a sudden, investors are starting to really having to think about the importance of yield. So that's what made us produce this report. But at the same token, we went, well, there's no point just improving your yield. What's the point of buying a property that doesn't grow? If it's just, if I give you an extra $100 a week in your pocket, it's not going to change your life. But 100 grand, 200 grand worth of uplift, it will. So it's important for us that we're targeting locations that are giving us that capital growth, because growth is what allows us to propel ourselves forward and go from one property to two to three to four. But in a high interest rate environment, yields really start to come into play. So that's what the inspiration behind the Pulse report was, and it is our most premium report. It retails at $900 a report. And as we say, there's going to be an offer on that later in the evening. But some of the results that you're seeing on screen here are from some of our picks from when were these ones, Terry?
Well, this is from
That's the current yield, yes?
our latest edition.
Yeah,
So basically, we select 50 locations around Australia that have got above average rental yields. They've got to have at least 6% gross rental yields. Some of them are unit markets, some of the house markets.
yeah,
But as you say, we also want them to be places we think have credentials for long-term capital growth, and they have to be affordable for people. So they tend to be places with medium prices, below 500,000. So the list on the screen is of the current list, the most recent. We publish this report quarterly. We've just recently published the most recent edition of it, and these are the top 10 locations on that list of 50 locations in terms of the rental yield. So you can see they've all got these locations have all got rental yields above 7%, between 7 and 8, and that's pretty good. If you're getting that kind of rental return and you've got a bit of a deposit put down the property, you're probably going to have a piece of real estate that's going to be paying its own way, which is not that easy to achieve in this high interest rate environment.
Yeah.
Blacks Beach is a suburb of Mackay. Mackay is in part of Darwin, and that's a unit market. Wales Stewart, industrial town in South Australia, one of the biggest population centres outside of Adelaide in South Australia. Carlton, obviously, inner city suburb of Melbourne. Rockhampton, that's the suburb of Rockhampton within the
Rockhampton.
the city of Rockhampton, which is a market that's going absolutely gangbusters at the moment. Frenzied, but it's a bit of a mini Perth at the moment in terms of demand from investors and home buyers. Very competitive. Port Augusta, another industrial town in South Australia, where you can buy houses in the 200,000s and get those really high rental yields. Travancore, which is another suburb of Melbourne. Gladstone, of course, in central Queensland. Moree, a really interesting town in regional New South Wales, one that's where you can, the median price for houses in the low 300,000s. It's got a regional centre that's got importance. It's on the route of the Inland Rail link, which we think is important going forward. But there's quite a bit of government investment going into Moree, and one of the things that's coming to Moree is a university campus, which is going to add to its economic diversity. And then you've got Ascot, which is a suburb of Perth. Keeping in mind the Perth market, which we think has sort of reached its peak, but we're also noticing there's a bit of a pivot in the Perth market. There's now a lot of buyers are actually targeting units because originally Perth was on the radar screen of investors because houses were really cheap, particularly in some of those southern suburbs. But now, after 2 or 3 years of big growth, they're not so cheap anymore. So they're now starting to target units. And places like Ascot are really well located inner city suburbs, close to the CBD, close to the airport. And so they're starting to get popularity for their affordability and their high rental yields.
It's probably, just before we jump into this next slide, it's probably worth just really quickly touching on the fact that we've noticed that huge trend towards units outperforming houses on capital growth. For any viewers here that aren't familiar with a lot of the media attention we've had through those that analysis, there has been markets all over Australia, and obviously the rhetoric for a long time has been you never buy apartments because they don't grow, but units in general in so many locations around Australia are outperforming houses in terms of capital growth. Not this year, not last year, but over a 10-year average, it has been, not only last year, not only the year before, but over a 10-year average, we've started to see units performing at double-digit growth. And I know you've said, Terry, in your career, it's the biggest paradigm shift that you've noticed in the real estate market.
It's a really significant change in property markets, and I think it's got legs. I think it's here to stay. It's not a flash in the pan thing. There are multiple reasons why more and more buyers are opting for attached dwellings, units, townhouses. It's not just about affordability. It's also lifestyle. It's also about security. There's a number of reasons why there's growing demand, and that growing demand for attached dwellings is causing capital growth rates to rise and rise. And so now they are competing with houses. So that's worth keeping in mind, because generally speaking, in a location, the units are cheaper than the houses. The rental yields can be much better. And if you're getting capital growth that's as good or better, then suddenly they come into play way more than they might have done in the past. So this is the top 10 list from our current edition of the Pulse. And just on that point of units, for the first time this edition, we've actually divided the top 50 into 25 house markets and 25 unit markets, because we do believe that trend is really significant. And given that we're talking first and foremost about yields in this report, and you do tend to get higher rental yields with units, although keeping in mind there may be some additional costs that bring down the net yield. But not necessarily, if you're buying small units, not in a big complex, that's not necessarily a big factor.
Yeah.
So rental growth, the top 10 on our current list of 50 locations in the latest edition of the Pulse. These are the best 10 locations in terms of the annual rise in median rents, and they've all risen at least 20% in the last 12 months, which is extraordinary. In my time, it's very, very, very rare to see rents growing that much. In fact, historically, we've typically had stable rental markets in Australia, maybe vacancies around 3% and rents neither rising nor falling much.
Yeah.
But in the last several years, that's changed because the vacancies have been so low. So we're now starting to see these sorts of numbers.
Yeah.
So Wonthella is actually a suburb of Geraldton, a very important regional city north of Perth. It's a market that's really prospered in the last couple of years on the back of the Western Australian economy being very strong and the property markets in Perth and elsewhere doing well. Mossman Park's a interesting one. It's one of the most upmarket suburbs of Perth for houses. You pay probably typically $3 million or more for a house, but units rather, by contrast, are very affordable in Mossman Park. You know, I
And
think the
that's
median.
one of the things that's dragging unit prices up, isn't it? Like there's just such a disparity between, the house prices and the unit prices. So naturally, especially in the higher interest rate environment, people are having to go towards that if they want to live in this location.
And I think it's a bit of a tip for investors to look out for. Look out for in our capital city suburbs where you've got suburbs with houses really expensive, like $2-3 million median prices, but units are like at affordable prices. Like a case in point in Brisbane would be Ascot Clayfield
Yeah.
suburbs. We're typically paying a couple of $1 million for houses, but you can buy units in sort of like in that $500,000 range in the same suburb. Mossman Park in Perth is another example of that. So you might just get greater uplift in unit values in that kind of circumstance. Warwick Farms are a suburb of Sydney, Greater Sydney, near the suburb of Liverpool. Affordable apartments there, close to lots of amenities. Withers is a suburb of Bunbury, which is one of the best performing regional markets in Australia in the last couple of years on capital growth. Place that we were recommending, 3-4 years ago, and it's really performed fantastically well on capital growth, as well as high rental yields. Lakemba, a well-known suburb, multicultural type of suburb in Sydney, in the Canterbury Bankstown local government area. Kerry Park's also part of Bunbury. Clifton Beach is part of Cairns in the far north of Queensland, a market that's also performed quite well in recent years. South Mackay, obviously part of Mackay. Glendalough is a suburb of Perth, and Rivervale, another suburb of Perth, part of the city of Belmont. It's one that we've recommended in our hotspots reports, our top 5 Perth hotspots. The city of Belmont is an inner city local government area with some of the suburbs fronting the Swan River. It's sort of nicely located between the airport and the CBD of Perth, and units are typically in sort of around the $400,000 mark. So very affordable for most people, very well located. So the sort of market that's really been targeted in Perth at the moment. But all those places on screen have had rental growth in the last 12 months, somewhere between 20 and 27%. So the next factor we look at is the vacancy rates, and these are the lowest of the low on our list of 50 locations in the Pulse report. They by the nature of these places with the high rental yields, they do tend to be places with even lower vacancy rates than is the norm. The national average is around 1.2% at the moment.
I mean, 0.2, you've barely got a doormat for rent in a suburb like that.
It's ridiculous, isn't it?
It is
When the
crazy.
vacancy rate is closer to zero than 1%, it's a pretty tight rental market. And
Mm.
not only does that mean that rents are highly likely to be rising, but in my experience, it's very unusual to have a market where rents are growing strongly and prices don't follow that trend. So
Well, this is an interesting topic, Terry, because we're showing customers here that you can get 6-7% rental yields today, and we've been touching on the fact that you can talk about gross rents and net rents, right? today you're getting 7% gross rent on some of these, and you might be netting 5. But as interest rates inevitably come down, these vacancy rates, looking on screen, we're not building enough new dwellings in these locations. So as much as we say that we've started to see a little bit of easing in some rental markets, in the markets you're talking about here, I don't see how it can change. It can only go in one direction.
Yeah, no, that's absolutely right. There's it's extraordinary, really, and I keep doing podcasts and writing about this. But this rental shortage has been with us for a number of years now.
Yeah.
Enough time for governments to actually make some decisions to move the dial, but they haven't.
Yeah.
The vacancy rate nationally at the moment is the same as it was a year ago, and pretty similar to what it was 2 years ago. When the current federal government came into power, the vacancy rate was pretty much the same as it is now. It hasn't changed. It hasn't improved. So we've got these kind of vacancy rates in locations around the country, upward pressure on rents.
Yeah.
And
The point I was going to make is that it can turn a 7% yield into a 9% very quickly. Like within a couple of years, if you can continue to see that rental growth, your gross rent continues to rise, but your net will get better as as the interest rates start to come down too.
well, that's right. And I quite often say to people, when you're considering the rental yield of the property that you're thinking about buying, don't just think about what the rental yield is now. Think what it might be in
Yeah.
2 years' time with the current market producing growth of and rents of 10-20% a year. Just do the simple calculation, see what your rental yield is going to be in a couple of years' time. It starts to look really attractive. If you're
Well,
also
Terry, you and I both talked about properties that we each own that we bought during COVID or sort of circa COVID times that are now getting sort of 8-9% yields. And these
Yeah,
are all in that affordability bracket.
absolutely right. Yeah. So it's a factor that just probably not often talked about, but it's a really important tip, I think, to take away from tonight
Yeah.
is think about what the yield will be in a couple of years' time, as well as the value of the property if it's getting the sort of growth we're about to show you. We haven't quite got there yet. We're looking at vacancy rates, and we've got suburbs of Queen Black's Beach in Mackay, Nightcliff's a suburb of Darwin, Dalby's out west of Toowoomba in regional Queensland, Merbaine's part of Mildura, which is a very strong regional city of Victoria, Mossman Park again in Perth, Glendalough in Perth, Port Perry's a industrial town, South Australia. Calliope is part of the Gladstone local government area in central Queensland, and Bundaberg South, obviously part of Bundaberg, which is a really important regional city of Queensland that we think is going to get a big boost to its capital growth because they're building $1 billion hospital there. They're just starting that project, and it's going to have a big impact on the economy and demand for real estate in that central Queensland city. So we've shown you some of the parameters that firstly cause us to choose locations for the 50 places that go on our Pulse report list. Low vacancies, and high rental growth and really high above average rental yields. But we're also looking for places that have the credentials as well as all that for capital growth. And these are the best 10 places on our current list of how much growth they've had in their median house prices or the median unit prices in the last 12 months. And you can see the growth in median prices has been exceptional. Everyone on that top 10 list has increased at least 22%.
I mean, just look at the prices they're at now, though. I mean, they're all just still so affordable, and these, all meet our empirical formula. So it's worth looking. There are probably viewers here tonight that don't know a lot of those suburbs, Terry, but it's worth stating in order for you to be seeing it on our screen tonight, it's gone through that empirical formula.
That's right, and it's worth making there's all sorts of learnings in the various scraps of information that we're presenting tonight. Well, one of them is that one of those myths and misconceptions about real estate is you've got to buy prime stuff to get the best capital growth. And I will always believe that's bunkum, and I always believe that the research proves that it's wrong. These are all places that are right at the affordable end. And as you point out, say Black's Beach units, it's median price in the mid 300,000 after growing 24% in the last 12 months. You imagine what it was a couple of years ago. And the idea that cheap real estate doesn't grow in value, rubbish. And here's the
Well, I
proof.
mean, I mean, you only got to look at the results. And if you go back and talk about the last 12 months, 15 jurisdictions that we sort of look at around the country, 8 capital cities and 7 regional markets, as you said, 6 of the top 9 were regional markets.
Yeah, that's right.
I
And
mean, the proof's in the pudding.
that's right. Affordability is outperformed so-called prime again and again in Australian real estate over time. And here's some more evidence of it. The suburb of Rockhampton and the city of Rockhampton, Kerry Park and Bunbury, Rasmussen, that's in Townsville, Wonthella's in Geraldton, Withers is in Bunbury, and then Midland, that's another suburb of Perth, and of course the suburb of Geraldton in the larger city of Geraldton.
So,
So the
Terry,
more
we have had a question jump in now, which I think is timely, and it comes. It's from Joy. Joy's asking if they've grown so much already, how much further can they grow? It's a great question.
well, that's right, and we're not presenting these locations as places we recommend you go and buy today. We're presenting these locations as an example of what can be achieved. But
Mm.
I want to make that point really clearly. We're not saying you should go and buy in these locations. We're just illustrating just the sort of locations that show this sort of exceptional growth in rents and prices. But yes, you're right. We're certainly have a very strong warning out for Perth at the moment, that after 3 years of growth, there's evidence that market has peaked, and we're not recommending people jump into that market now. And that's also true perhaps of Bunbury, which is similar to Perth, has had major growth over the last 2 to 3 years, and Withers on that list has grown 26% in the last 12 months alone. Not necessarily smart to be buying there now. The secret is to be finding locations with the potential to do that haven't had that level of growth yet. And
Well, there's that, but there's also you have to bring back the median price to the wages in the area as well and the population density. Can that market, you can't say because one market's had 42%, it won't continue to grow. Equally, you can't say that somebody's had 10% growth in the last 12 months, can't continue to grow. You have to look at the individual locations, look at the base income, and obviously, depending on what time that you're looking at in terms of interest rates and things, the affordability factor changes. So some markets like Rockhampton, $330,000 median price today, the income's there and there's a lot of fly in, fly out. I know it's not the only thing that supports a Rockhampton. It's a very diverse economy now. But the fact that it's got a median price of 330,000, the incomes there can support more growth.
yeah, that's right. So, some of these places will continue to grow, but I think it is worth emphasising that we're not actually recommending these places for people to buy now. We're trying to illustrate what's achievable if you get your locational choice right. Now, we've taken that information from that slide and put it onto a bit of a bar chart just to make it even more graphic, just how exceptional that growth has been, particularly when you compare with the national average on the right-hand side of the slide. 6% is the average national growth in median prices in the last 12 months. And you can see how exceptional these locations have been. Locations that we chose originally primarily for their high rental yields. Okay, so just to bring home the point, we're now going to focus on 10 individual markets and that have sort of ticked boxes in all sorts of directions, got great numbers in every parameter virtually. 5 house markets from our Pulse report and 5 unit markets. Just to bring home the points that we're making. Blacks Beach has popped up on a number of those lists. Popular northern beaches area of Mackay. It's been heavily targeted recently by property investors. So the Mackay market's become very busy, very competitive. The median price for houses in Blacks Beach now about 480,000. That's after 14% growth in the median price in the last 12 months. You can see from the days on that DOM days on market, properties typically selling within 2 weeks. Popular market over 200 sales of houses in the last 12 months. Rents also up a lot. Vacancy is almost zero, and the median rental yield 6.5%. Those are great numbers. Now, if you'd bought in this market 12 months ago or 2 years ago, you'd be a very, very happy investor. You would have bought probably somewhere in the 300,000s if you bought 2 years ago, and you'll be getting fantastic rental yield and enjoying that sort of capital growth that we've seen in the last 12 months in that suburb of Mackay. Calliope, it's actually a standalone town, but it's part of the city of Gladstone local government area. It's just a little bit outside of Gladstone, but we consider it part of Gladstone. Therefore, it sort of meets the criteria of our empirical formula. It's only 20 k's from the Gladstone CBD. Again, you can see from the median price on the left-hand side, they're affordable, low 400,000s. It's only grown actually 7% in the last 12 months, but looking at the 5-year averages, it's averaged 11% per year for the last 5 years in capital growth. And any market that's averaging that high over that length of time is a very good performer. Rents are up 18%, vacancies 0.5%, and typical yields are sort of between 6 and 7%. So that market has performed really, really well. And it's not a market that is well known. It's not a market that many investors would have put their hand up and say, I want to buy in Calliope. But those that did will be very happy investors. Again, this is Kerry Park in Bunbury, and we would emphasise that after a couple of years of big growth, we need to consider whether it's a good time to be getting into that market. What you'd perhaps be looking for is the next Bunbury. Where's the next Bunbury to be found in right across this big country of Australia? But despite the fact it's had 29% growth in its median house price in the last 12 months, its median price is still in the low 400,000s. But look at its 5-year growth average. It's averaged 15% per year.
Don't worry about the numbers, Terry. Look how beautiful it is. I just want to live there.
Well, yeah, I mean, that's actually an image of Bunbury rather than the suburb of Kerry Park. But yeah, I mean, Bunbury's got a lot to offer. It's got a really strong economy. It's well connected to the capital city of Perth. It's on the ocean, obviously. It's affordable. It's got a great lifestyle. There are plenty of jobs there. Yeah, I mean, a lot of people are very happy to live in that kind of environment.
Yeah.
But be mindful that prices and rents have risen a lot, but it's again wonderful numbers for anyone who bought there a couple of years ago. And just to illustrate just how much growth that market's had, this is from our research hub on the hotspotting.com.au website. The 5-year growth chart for the median house price for Kerry Park, suburb of Bunbury. You can see it's just been a tale of very steep growth since about 2020, but particularly in the last couple of years. Fantastic performer. Coongall's a suburb of Rockhampton. We've talked a bit about tonight. It's really being targeted heavily by investors this year. We had a bit of a look there, Tim, didn't we? When I was looking for something a couple of months ago, and it was just too hot.
We got blown out of the water.
Blown out of the water. You have to offer above the asking price, well above the asking price to beat the competition, and that's not necessarily sensible buying. But this suburb, despite the fact it's had that massive growth in the last 12 months, and it's averaged 16% per year for the last 5 years, median price still below 400,000. Incredible stuff. Really good rental yields. But be warned, if you want to jump into that market, excuse me, it is really hard to buy in that market because it is just so competitive. One fella, again, we've mentioned it a couple of times because it's made a number of those previous lists tonight, suburb of Geraldton. A little bit like Bunbury. Look at that environment. You wouldn't mind living in that city. It's got a lot to offer in terms of lifestyle, as well as it's an economy that's quite strongly influenced by the resources sector, but there's more happening in Geraldton, so we're happy to recommend it because it's got a big tourism industry and there's manufacturing happening there, and there's quite a lot of state government investment going into Geraldton, so we feel it's not a high risk market.
Yeah.
And you can see the sort of growth that's being achieved there in the numbers on the left hand side there. So those are just 5 standout house markets from our list of 50 in the Pulse report, and just turning to some of the unit markets. Bowen Hills, central city suburb of Brisbane, right on the doorstep of the Brisbane CBD. Until very recently, the median price for units was in the 400,000s. They've had a lot of growth, and it's now in the low 5s. but a great location, not only on the doorstep of the CBD of Brisbane, but also walking distance to the biggest hospitals complex in Brisbane. It's actually just over there. I don't know if you can see my cursor on the right-hand side. That's the Royal Brisbane Hospitals complex. Something like 6,000 people work there every day. So we're starting to see capital growth happening in markets like Bowen Hills unit market, up 15% in the last 12 months. Pretty good rental yields for an inner city location. Not many major capital cities can give you a rental yield above 6% right in the centre of the city, and low vacancies. So the numbers are pretty strong for Bowen Hills. Glendalough, suburb of Perth, again, very affordable. Amazing growth of both rents and prices in the last 12 months. Vacancies closer to 0 than 1%. The city of Stirling, a little bit north of the Perth CBD, always strong. It always seems to feature in our Hotspots reports because it's got such great infrastructure, great location, including beach suburbs, and there's sort of price point to suit every budget. You know, you've got you can buy in the 300,000s if you're buying units in a suburb like Glendalough, and you can buy $1 million property there in the city of Stirling as well. But in this case of this example, rental yield is pretty close to 7% at the moment, despite all that price growth I've had. Harris Park, one of those down market suburbs of Sydney, but yeah, a lot of people buy there because it's affordable and the infrastructure is good. It's on the doorstep of the big Parramatta CBD. You've got train links, you've got motorway links, plenty happening in the local economy, and you're starting to see big demand for units in that suburb. Prices and rents have risen a lot. Another Sydney suburb that's very similar is Lakemba, very multicultural, part of the Canterbury Bankstown, one of the strongest markets in Sydney, Canterbury Bankstown, because it offers relative affordability both for houses and for units. And the 5-year, you can look at the 5-year growth average. It hasn't shown a lot of capital growth in time. We're suggesting that we think that will change because there's more and more demand for units. And locations like this have got great infrastructure, not so far from the centre of Sydney, very affordable, vacancy is very low. There's plenty of good reasons why you might consider buying a unit in a market like that. And again, Rivervale, I mentioned it before, the city of Belmont. And so it's got that location on the river. It's just to the right of that picture, you'd find the yes, I think to the right will be the Perth airport. To the left is the Perth CBD. Rents up 20% in the last 12 months. So yeah, again, you can see the 5-year growth average. Units in Perth long-term haven't shown good growth. We're suggesting that that's changing, about to change, is changing because there's a big pivot in the market, more and more people demanding units. Okay, so that's the highlights of the Pulse report. One of my favourite reports. I really enjoy working on it every quarter. We produce 50 great locations that produce those sorts of results for people. And so it's, really happy to have a report like that in our stable of reports. So we've got a little bit of time left, Tim, for some more questions, and also we'll finish off with the special offer. Just let me know when you want to.
Well, in typical Tim and Terry fashion, we can talk about real estate forever. The hard part is to shut us up. So we've gone over time, but we do have a couple of questions. So I apologise to Gillian. Gillian, you did have this question in there earlier, but I just couldn't get in. One of the questions she's asking is, what is the cycle timeframe in years on average? For example, do you find areas you recommend rising for like 3 to 5 years before reaching a plateau in growth? It's probably hard to do that as a basis across the whole country, but what would you say there, Terry?
Yeah, look, I think 3 years is kind of a good average. And as you point out, Tim, it's not the same everywhere, and it's not the same every time. Because I just showed you a graph earlier for Carey Park and Bunbury, where clearly its median price has been growing steadily for 5 years, and it's still growing at the moment. But that's probably a bit of an outlier. Normally, we find that maybe 3 years of growth, and then the market sort of reaches a peak. You tend to have a flatlining period of maybe 18 months, and then it starts to grow again. And the markets are at that point of the cycle right now, the ones we call the second wind markets, and the ones that we're really interested in because they're not frenzied, they're not competitive. It's a good time to be buying in those places if there's credentials for future growth. But yeah, I'd say 3 years is a good average. But as you can see from the example we showed before with Kerry Park, there are exceptions that do better than that.
Yeah, absolutely. Another question here, it's anonymous attendee, but if the current data isn't favourable, but there is strong infrastructure in the pipeline, do you think this is a good reason to buy against the grain?
Absolutely, absolutely. One of our mantras at Hotspotting is the past does not necessarily inform the
Yeah, I was going to
future.
go there too.
Yeah, some of the best performers over the last, say, 3, 5 years in Australia have been places that prior to that growth had really poor track records for the previous, say, 10 years. Now, Perth is a great example. It had 10 years prior to its current boost where prices were actually falling.
Yeah.
And when we started recommending locations in Perth 3, 4 years ago, people were saying, why are you recommending this market? It's been falling for 10 years. Well, we could see something was going to change, and something certainly did change. The Sunshine Coast, about 2020, when we had it in our national top 10 best buys report as our top pick, and for the previous 10 years it had no capital growth at all, and people again were saying, why are you recommending it? Well, because of the huge infrastructure spend, we could see it had to change, and it turned into one of the best performers in on capital growth in the country. So
Yeah.
the Sunshine Coast is a really good answer to was it Gillian? To
Yeah.
Gillian's.
Oh, not this question, the previous one, sorry.
Yeah, a really good answer to that question is the Sunshine Coast. So yes, if currently not growing much, hasn't had a great record in the recent past, but there's some reason to believe it's going to change because, for example, there's a big infrastructure
I think
spending.
the key word there is change, isn't it, Terry? Like at the end of the day, if you just based your investment decisions on historical performance, then you would never have an opportunity to take advantage of being a first mover. And ultimately, in order to do that, you need to see change, and that's what's going to allow you to jump in and take advantage of those opportunities. The next question I had was from Steve. Are these current recommendations or ones you have recommended previously? So
Yeah. Yeah, well, yeah, as I pointed out earlier, these are not locations we're necessarily recommending now. We're putting those examples up to illustrate what can be achieved if you choose your locations well. But what we're suggesting to people is what you need to find is locations that have those sorts of credentials to do similar things. But some of those markets have reached their peak or are very close to it. Yeah, we're not necessarily saying rush out and buy in those locations.
Yeah. I've got a question from Dilip. Dilip, good to see you. He's seen our new TV show Ticker Video. He said you mentioned in your ticker video, you mentioned about the Melbourne, Wodonga, Albury, and Toowoomba, but these were not presented in this presentation. It's an interesting one. So I might quickly touch on Melbourne. I think right now there's certainly a lot of attention on Melbourne, and one of the reasons for that, or probably the only reason for that, is because relative to a lot of other capital cities, it actually seems affordable. We're the largest capital city in Australia now, having recently taken over Sydney, but one of the challenges we sort of see here now, if we think about the property clock, it's definitely at the bottom of the market. But how long we stay here for, we're not entirely sure. Now, as I say, I think the main reason people are showing interest in Melbourne right now is because it seems relatively affordable. But our concern with Melbourne, certainly my concern with Melbourne, is that it's our state government here has got more debt than every other state in Australia combined. And once we actually reach our peak debt level, we'll be paying $1 million an hour just in interest. So that's concerning, especially when you think about where most of the employees in Victoria are actually paid from. There's a statistic that 51% of Victorians are either paid directly or one removed from the state government. So they're either directly or indirectly paid from state government. And we're in that much debt that it's quite alarming. Outside of that, we obviously pay higher stamp duty. We pay land taxes that are much a lower threshold and things like that. So it's not that I don't think there's good opportunities here in Melbourne. It's not that I would say don't buy here in Melbourne or in regional Victoria, but certainly do your due diligence and make sure that if you are coming into an area like this, you don't mind sitting and waiting for growth for a little bit, because we're not seeing huge rising sales activity right now across the board. And I think it's wise to, well, I'd just say there are probably better opportunities out there is probably my point.
Yeah, but I think Melbourne's time will come. And in fact,
Yeah.
I was doing a podcast on that very subject, because we're very soon going to publish the next editions of our top 5 Melbourne Hotspots report and the top 5 regional Victoria report. There's a turn in sentiment towards Melbourne and Victoria, it's certainly a case of watch this space.
I think part of that's opportunistic as well, though, Terry. I can't see why a lot of people are jumping at it, other than people thinking, oh, it's a good opportunity to buy because it's cheaper than everywhere else. But we want to start to see a little bit more positive news in other areas, other than, hey, it could be a good time to buy.
Yeah, I mean, there are some positive parameters for Melbourne. Population data, it's actually leading the country in that regard.
Yeah.
The economy's, are ranked sort of mid-range. It's certainly not the weakest in the country. There's quite a big infrastructure spend happening around Melbourne. That's a generator both of activity economically, but also a generator of debt, and that's one of the problems you raised. But we probably shouldn't get sidetracked too much into talking about Melbourne. There are some of the other places that
Toowoomba and Albury-Wodonga.
Yeah, they're not on the list at the moment. One of the reasons for that is because prices have risen in the past, particularly in Toowoomba. The rental yields have come down. The rental yields in Toowoomba at the moment, really, generally speaking, aren't high enough to make this list for the polls. There are other good reasons to buy in Toowoomba if particularly going for capital growth in a city that's got great growth credentials. Then certainly Toowoomba's worth considering. And so is Albury-Wodonga. I really love that city in terms of its economy, the strength and diversity.
And a 5 and 6% rental yield is achievable there in houses too.
That's right. So it's certainly not the worst. And it's one of those second wind markets that we're talking about tonight, that it's not frenzied. You can go there and have a look and not be competing with a lot of other buyers in days on market. And some of those frenzied markets are like 10, 12 days, whereas in Albury-Wodonga it's more like 30, 40 days. So it's a more normal market. Yeah.
Dilip's got a follow-up question to my answer, just asking about the property clock, asking if we refer to the Harron and Todd one or if we have our own. We certainly use a property clock in terms of us thinking about rising and declining markets. We don't publish a property clock, so to speak, but what we have is the price predict index, which talks about short-term time in market. So every quarter we analyse every suburb in Australia and commit to a ranking. So our members that get access to our property portal, you can search any suburb in Australia and see where it's at essentially on the property clock, as well as accessing the price predict index report, which we publish every quarter. We've probably got time. We've already gone over time, Terry, but we've got time for one more question, which is, have you seen properties in regional areas grow more compared to major cities? And I suppose the quick answer is that yes, 6 out of the top 9 in the last 12 months were, by percentage of growth, the best performers in the country as regional markets, outperforming the major capital cities. So Melbourne, for interest's sake, was at 14 on that list. So there's certainly some capital cities that made the list, but the regional markets definitely led the way.
Definitely, regional markets have been outperforming their capital cities as a general statement for a number of years now, and that trend we call the exodus to affordable lifestyle is in large part responsible for that, and that trend continues, by the way. And there's still plenty of momentum of people leaving the 2 biggest cities and moving to smaller places which are more affordable and have a different lifestyle. Enabled by technology, more people can work remotely than has been the case in the past. Tim, should we
Yeah,
Move on.
let's move on quickly to the final option in terms of an offer for everybody. So heading into the end of the year, we have got a special promotion on strategy sessions. So you can book either a strategy session with Terry or myself, which is a 45-minute session where you'll actually get a free copy of our latest Pulse report. As I mentioned previously, we sell that report at $900 a report. So our strategy sessions are either $385 with myself for 45 minutes or for the big guy, $495. And as I say, with the $900 report, it makes it very good value. So the purpose of us doing that, we'll obviously talk to you about some of the markets within these reports if they are of interest. But if there's interest outside of that and you're wanting to target growth and things, we can also offer you some insights on some other areas outside of the Pulse report. So do take advantage of that offer because it is a limited time. We'll keep that open until 31st of December. But obviously, if you're seeing that now, jump on the QR code and book an appointment. We'd love to have a chat with you, and you'll get some good value out of it. Terry,
Indeed.
Any final thoughts?
Yeah, look, just to summarise the theme of tonight's presentation, we really want people to understand that if you choose your location well, you can achieve affordability, you can achieve really high rental yields in times of high interest rates, but you can also get great capital growth.
Yeah.
And the purpose of the case studies we showed tonight was illustrate, what has been recently achieved, what can be achieved. You don't have to choose between high growth or high rental yields. You can have both if you get your locational choice correct.
Very good. Well, Terry, I know myself, I enjoyed that presentation, so hopefully everybody else did. We had a 100% satisfaction from our survey, so thank you to everybody who contributed to the polls. Thank you everybody for turning up and listening to us tonight. We will be sending out replays of this in the next 24 hours in case you missed anything or you would like to share it with somebody else. Do us a favor and subscribe to our YouTube channel so you don't miss anything, and feel free to reach out to the contact details, Tim at hotspotting.com.au or Ryder at hotspotting.com.au if we missed any questions or you didn't get an opportunity to ask them. Thank you again, and we look forward to seeing you next time.